Hi, this is Mike Larson from Money and Markets TV. The world is a very dangerous place right now, and investors looking for safety and growth are in a tough spot. In Europe, despite news of what seems like the 100th Greek deal, default is still just a matter of time. In the Middle East, tensions are ratcheting up. Syria is in chaos, and an Israeli military strike on Iran is a real possibility. And here in the US, many economic indicators suggest the recovery is far from robust. For all those reasons and more, I've counseled caution and patience when it comes to investing. But that doesn't mean you should convert all your assets to cash. There are select asset classes, sectors, ETFs, and stocks that I feel you can buy with more confidence. Investors are searching not just for safety in today's market, but for income as well. Now, junk bonds are one type of investment that offers higher yields, but they come with significant credit risk. The same can be said for emerging market bonds. They offer higher interest rates, but slowing global growth threatens to wipe out their value. Instead, I'm recommending shorter-term, high-grade corporate bonds, bond funds, or ETFs. The fact is, some corporations are in better fiscal shape than many sovereign countries. iShares has several good offerings available on its website under fixed income ETFs. You can also get higher yield from master limited partnerships, or MLPs. These entities transport and store natural gas and petroleum products, and they pay out handsome dividends with the cash that those activities generate. And the good thing about MLPs is that they make money no matter what's happening with the underlying commodities. After all, it doesn't matter if gas costs $2 a gallon or $5 a gallon, companies still need to get crude oil from the fields to the refiners in order to produce it. And if you want to focus on the stock market, there are even some select good plays there. But remember, this is not the time to have broad exposure to the S&P 500. That's because it's being artificially inflated with cheap money from central banks in Europe, the UK, and the United States. The problem with that QE-driven approach to the markets is that when the taps are turned off, stocks don't just gently float back to earth, they collapse completely. It happened after QE1, and it happened again after QE2. During the second round of quantitative easing by the Fed, stocks steadily climbed for 8 months. Those gains went up in smoke in just 2 weeks last summer. Plus, you have to keep in mind that this market is still fraught with big macro risks. The debt crisis in Europe isn't going away, America's own balance sheet is getting worse, not better, and it's unclear how much longer bond investors are going to put up with Washington giving them the shaft. So if you're set on buying stocks, invest only in select, targeted opportunities in sectors like restaurants and healthcare. I've identified several strong candidates in my Safe Money report. I'm Mike Larson for Money and Markets TV. Thanks for watching.